Hello friends, welcome back to a new lecture. In this lecture, we will learn the second set of two candlestick patterns, that is piercing line and dark cloud cover. Let's start with discussing piercing pattern, which is a bullish reversal pattern. Friends, the piercing line is a 2-day bullish reversal pattern. Thus, this pattern is of importance when formed in a downtrend. This pattern can be identified by the feature that here the second day's green real body pierces back into or above the midpoint of the first day's real red body. Or simply you can say that the second day's green body must have a gap down opening but closes at 50% or above the first day's red body, that is here. A typical piercing pattern can look like any of these. Important point here is to note this green candle which opens below the close of previous candle but closes above this 50% dotted line. Friends, hope the concept is clear to you and you can easily identify this on your charts. Let's now look at the psychology behind formation of this pattern and why it leads to reversal. Friends, just say the market is in downtrend, as this first red candle also implies the control of bears. In next session, the market has a gap down opening and opens below the low of the first red candle, which indicates that bears are still holding the fort and suggests continuation of downtrend. But soon big players start buying at these low levels, which led to loss in momentum of bears. The bulls conquer and takes the price up during the session and eventually manages to close above the 50% levels from the previous day's candle body. So friends, by now you can analyze that this reversal pattern is less powerful than bullish engulfing, since in bullish engulfing, bulls come out strong and close the candle above the red candle body. But in piercing, the bulls came out strong but not as powerful as that of bullish engulfing. Friends, a small historical fact here. The Japanese used to give great importance to number 2 candle of any pattern. They have found over the centuries that if bull manages to close the second day's candle more than halfway above the red candle, then the probability is very high that reversal is real. Let's look at the trading setup and see how to apply a tree strategy here. First, the trend must be down in case of piercing pattern. Then the region of interest. Now friends, since this is a bullish reversal pattern, so this should form around support levels. Now this can be a trend line or horizontal support level, a moving average or even Fibonacci levels. Now for RSI, the RSI should be in oversold levels. Now friends, the entry level can be open of next candle, that is day 3 candle if there is gap up opening, else wait for next day's candle, that is day 3 candle to close above the green candle of the pattern. Only then take the entry. Our last step of the strategy is E, that is exit. Now friends, you can take your target at previous resistance or previous swing high. If the previous resistance or swing high is much higher and you don't expect that to cross, then you can even exit at 50% of that level. Or you can even exit with 1:2 risk to reward ratio. As said, take your targets rationally, seeing the overall picture of the market. Let's see a practical example from Nifty chart. As you can see, the trend is down for so many days, which is followed by formation of piercing pattern as shown in the yellow box. Now, when you analyze both the candles, you will see day 2 candle close below the closing of day 1 candle and close just at the 50% mark of previous red candle body. So the piercing pattern form is in fact a valid pattern. Let's move ahead and apply a tree trading strategy. We will next check if the pattern is formed at a region of interest. For that, I will zoom out the charts so that we can have a larger picture of price action of the market. Now here is our piercing pattern, and when you see carefully, you will notice that the pattern is indeed formed at a region of support. Thus, it's highly probable that reversal may happen. Finally, we will check the RSI. Now the RSI is touching the oversold region. We will accept this and take our entry at opening of this next day's candle, which was gap up by the way. The aggressive target will be this upper swing region, which got hit here, but conservative traders can take the target with 1:2 risk to reward ratio. Friends, hope the example is clear to you. Let's move on to the other pattern of this set, that is dark cloud cover pattern. Friends, the dark cloud cover is also a 2-day bearish reversal pattern. Thus, this pattern is of importance when formed in an uptrend. This pattern can be identified by the feature that here the second day's red real body falls down below the midpoint of the first day's green real body. Or simply you can say the second day's red body must have a gap up opening but closes at 50% or below of the first day's green body. A typical dark cloud cover pattern will look like any of these. Important point here is to note that this second red candle, which opens above the close of previous candle but closes below this 50% dotted line. Hope the concept is clear to you and you can easily identify this pattern on your charts. Let's look at the psychology behind formation of this pattern and why it leads to reversal. Friends, as the trend is up, the bulls are in full control, and first green candle of the pattern also indicates the control of bulls. In next session, the market have a gap up opening and candle opens above the high of the green candle, which shows that the bulls are still in control and may take this rally forward. But as the market becomes overheated, big players enter the scene and starts profit booking and again takes new positions in the market. The bulls then lose the momentum as the bears start conquering the market. The bears then take the price lower during the session and eventually manages to close the price at 50% or more from the previous session. Friends, hope the psychology behind this pattern is clear to you. Let's understand the trading setup for dark cloud cover pattern. Now the trend must be up in case of dark cloud cover. Next is region of interest. Now friends, since this is a bearish reversal pattern, so this should form around resistance levels. Now this can be a trend line or horizontal resistance level or even a moving average. Now for RSI, the RSI should be in overbought levels. Then friends, the entry can be opening of next day's candle, that is day 3 candle if it's a gap down opening. Else just wait for next day's candle, that is day 3 candle, to close below the red candle of the pattern. Only then take the entry. As said earlier, always take your confirmations and never trade candlestick in isolation. Finally, you can take your target at previous support or previous swing low. If previous support or swing low is much lower and you don't expect that to cross, then you can even exit at 50% of that level. You can even exit with 1:2 risk to reward or trail your stop loss to ride the profits longer. Let's see an example to understand the setup better. This is the chart of US stock Facebook. As you can see, the stock is in uptrend here, which is followed by the formation of this dark cloud cover pattern. Let's check if this is a valid pattern or not. Please note the first candle is a long bullish green candle and the second red candle had a gap up opening and closed into the 50% body of the first green candle. Moreover, since this pattern is formed in an uptrend, thus it's a valid dark cloud cover pattern. Please notice this pattern is formed at this resistance level. Thus point 2 of our setup holds good here. Then we will take a look at RSI. The RSI is also giving its confirmation. Finally, we will wait for the next candle. As you can see, next candle closed below the pattern, which gives us a go ahead with the trade at around this level. Our target as per setup will be the swing low, which unfortunately was missed. But conservative traders with 1:2 risk to reward ratio could have achieved their targets very easily. Friends, even though aggressive target was missed, but still for traders who would have trailed their stop loss, this trade was in fact a profitable trade. So friends, with this I wind up this lecture. Hope this set of 2 candlestick patterns is clear to you. In next lecture we will learn the third set of 2 candlestick pattern, that is Harami candlestick patterns.